More secondary market action. Let's actually kickstart the show by talking about what's happening in the primary markets. And there's a new kid on the block very, very soon. I'm talking about another IPO that's making its way to the street. The IPO is Maharashtra-based heating equipment company, JNK India. Now, this is an issue that is opening today. The company has fixed a price band of 395 to 415 rupees per share. And this is 650 crore IPO. The closing date is 25th. It's a mix of, a fresh issue as well as offer for sale by existing investors. We have with us the company's management, Chairperson Arvind Kamath and CEO Deepak Bharuka of JNK India. Gentlemen, thank you very much. Thanks for joining in. We were just going through some of the details of your company. You seem to be in a very niche space and you have a lot of market dominance, right? Because you make heating equipment which refineries need, which petrochemical plants need, and a whole lot of other industries. So just go over the details and, whether you expect to keep maintaining the market dominance that you currently enjoy.
Yes, Surbi, absolutely. As you stated, the new kid on the block, it's apt because we are like a 13-year-old kid in the candy store now. So, yeah, we are dominant in the refinery and petrochemical market in India. But not only in India, the export market also great opportunities there going ahead. So, our TAM for next 5 is something like 63,000 crores. Okay. That's as per the F&S study for the 5 years cumulative analysis. So, hope that, there's a great runway ahead for us.
The 63,000 crore of TAM, is it domestic or is it including exports?
It's a global. Both put together.
And you've also said your market share is 27%.
It's only domestic.
That's a domestic market share. Yeah. Okay, right. Got that. Also, if you could just talk about, we were having a look at your numbers. In 9 months, FY23, sorry for jumping straight into the financials, it's about 253 crore, which compares with FY24 revenues of 400 crore. So simply doing the math, it would appear that FY24 revenues might fall short of what you've done last year, while margins have expanded. So can you explain that for us?
Yeah, Leena, see, in our business, quarter on quarter, it kind of depends on the what projects are dispatched and what execution is there. Last 3 years, if you see, generally, first 3 quarters and the last quarter, the ratio is about 50-50 or 40-60 or 60-40 that way. So the large chunk of revenue gets booked or shipped in the last quarter.
Okay. So, but even if you assume 60% of your revenues come in, it would still mean a flat or a minor growth, right, in FY24 versus FY23?
Not really. We're not allowed to say the exact figures because it's not yet in RHP.
Okay. But is there some slowdown that we've seen?
No, not at all. Not absolutely not. We're looking for a great growth ahead.
Yeah. Okay, let me now talk about the margin improvement that you've showcased in 9 months. It's very, very substantial, right? Because you were averaging around 17-18%. Then 9 months of the previous fiscal, you've touched 26%. So what changed? And is this sustainable?
Yeah, see, when it comes to the margin, it is unfair to look at the quarterly margin. For our kind of business, you should always look for the yearly margin.
Which has been 17 to 18% for your business.
When at the end of the year, we will probably surpass it by a couple of percent. But then 27% is more on a 9 month, which we had to declare to the SEBI at the time of filing.
So annual margins will be expecting to hover in that same range.
Steady or a couple of percent here and there.
17 to 18. So, okay, let me try now, get a little away from the numbers to understand, again, the business dominance. You have a lot of the large conglomerates which are your clients. Right. I suppose Thermax or maybe BHEL, they're in the same space as well. So what about competitive intensity? Do you have any levers to charge more for your products and services? I'm now talking about a 3-year trajectory in terms of the revenue and the margin profile of the company. What can shareholders expect?
Yeah, basically, see, the space which we are in is a completely engineered and fully custom-built equipment. So it's not that there are not so many competitors in this space who have got references and already credibility in this very proven, only few companies in Europe. Okay, there is competition, as you said, in India to a certain extent in the basic equipment, that is fire heaters. But we also do reformers and cracking furnaces, which are more high-end, and there is no Indian company in this space, basically.
And from what we gather, you're looking to go big on the electrolyzer and the hydrogen space as well, right? Just explain your presence there right now, because that's the big thrust. For instance, Reliance is setting up such a huge factory at Jamnagar, right, on this. So what is the potential on green hydrogen?
See, to start with, currently we are executing India's first on-site generation dispensing hydrogen station for ICL in Faridabad. And going forward, we see this space will show a lot of growth in India, and otherwise also, if you see in Korea, there are almost 200 plus hydrogen fuel station they are having. And when a country of that size having 200, you can do the math for what numbers will be coming up in India. But we see it will take another 3 to 4 years for that space to really grow and give us the substantial revenue. But we are doing our R&D and we are making ourselves competent to handle this project when they come.
Just a final point to understand again the margin profile. When you supply heating equipment for the green hydrogen industry, does it typically fetch better margins or is it at par?
Green hydrogen industry does not require the heating equipment. It is a different space altogether. For the heating equipment space, yes, our margin profile is as historically we have depicted, and it is mainly because of the competition. We hardly have any competition from India. The companies which we are talking about, big conglomerate, they are big in some other sector. They are not so big in the sector where we are having a dominance. Our competition is mainly with the European companies. And because we don't expect many new companies to come because of the entry barrier. See, our main USP is we have crossed the entry barrier if you see our growth, in last 3-4 years it is phenomenal. Before that it was quite sluggish. And this main reason is we have crossed that entry barrier combined with Make in India and other factors that is giving us the edge over others.
Okay. Are the margins similar between exports and the domestic sales?
More or less, but yes, in the export you can expect couple of % more because all export orders are in US dollar. And then again, competition is altogether different in the export
So how much
market.
better are export margins? 200, 300 basis points higher?
Couple of percentage you can say.
Percentage points.
I mean,
And
not
also
more
your
than that.
mix between India and overseas has changed dramatically. So FY21, India was 36% of revenues, which has now moved up to 80%, 81% in 9 months.
Yes,
so
yes,
can you explain that?
I mean, generally we've been like last 3 years, if you see, 60% has been exports and about 40% has been domestic. Only these 2 years would be, it's flip, I mean, vice versa. Yeah, because of the Make in India, we got, accepted with a lot of opportunities with the PSUs in India.
So is there a PLI scheme for where you operate? Or
No, not really. But then Make in India, what they did is all this heating equipment business earlier, because it up to around 200 crores, 250 crores kind of inquiries, they would send global inquiries because there are not enough companies in India who make this. But because of Make in India, we would got qualified and, quoted for these jobs. And that's how we're executing a couple of jobs for Indian refineries now. But going ahead, the opportunities is more in export. So we see a similar trend going ahead.
And
So
what's the mix then? What's the mix that eventually you will have, domestic and exports
I think
mix?
it could be about 50-50 or exports could be about 60 or so. That's the,
Okay. Just one more question. Since you're saying that the company's orbit changed in the last 3 years, right? And you've developed a moat around yourself, So can you tell us, in the last 3 years, your domestic revenue growth was 59%, export revenue growth is 79%, I believe, right? Is this the run rate we should expect, going forward? And also, is there scope in the long term for you to expand margins? Is there anything in your business plan which allows for margins to cross to 20% plus sustainably?
See, on a sustainable basis, as Arvind explained in the start itself, total market TAM is around 70,000 crore globally. And you can do the kind of turnover we are doing, revenue we are talking now and future. And we'll be qualified and eligible to do most of these projects which will be coming in the India and in the global space. So definitely as we go ahead, we don't expect some drastic change in the margin either way, but we are confident that we'll be able to maintain the margins as going forward.
Just one last question to go back to the hydrogen business. So you have a lot of dependency on traditional oil and gas refining right now, right? I think over 90% of your business comes in from this sector, if I know the right numbers. But just tell us about business de-risking plans going forward. And you are also apparently looking at technology tie-ups. I'm not sure whether it's electrolyzers and hydrogen or some other space, and also acquisitions. Just an outlook on how will the business look in terms of the mix across different sectors and verticals.
Yeah, see, basically, I mean, oil and gas is refining is one part of the business, but there's a lot of scope in fertilizer and petrochemical space. Actually, a lot of opportunities are coming in India in petrochemical. We still very, comparing to the production and consumption of petrochemical, India is still at a very nascent stage comparing to the developed countries. So in petrochemical, our capex in terms of the cracking furnaces has large opportunities. And even fertilizers, which are coming up a lot in Africa and the other Eastern European or Australia or Indonesia. So there are a lot of opportunities for reformers in these countries as well. Yeah.
Okay, so oil and gas, petrochemicals, fertilizers, three big sectors
yeah,
for you.
Absolutely, yeah.
And green hydrogen, don't forget.
And green hydrogen, yes, as and when that kicks off. But do you have a timeline for that? I mean, by when do you think that
No, there are a lot of initiatives, maybe, but we expect another 2 to 3 years' time, it should give us the big business as we move forward.
Okay. All right, gentlemen, thank you very much for joining in. Good to have you in the studio and good to understand your business, and all the best with the IPO plans.
Yeah.
Thank you.
Thank you.
Sir.
Well, with that, we do have to take a very quick break.